Hello, this is Dale from Loan Cabin. I'm here with Jack, a non-QM underwriter slash specialist. We're here to talk to those of you who've had a recent credit event. What do I mean by a recent credit event? I mean, did you recently have a foreclosure, a bankruptcy, something that has not allowed you to go get FHA or conventional financing? Well, there's a whole market out there for people who have the money to put a considerable down payment, 15, 20, 25% down. And I want to give you an example of a client that I helped close about a year ago that was a perfect fit for the kind of product that Jack offers. The client went through a bad divorce. Along with that divorce came a foreclosure and a bankruptcy. And the client was about a little over 2 years outside of that, which did not allow him to qualify for FHA. Found a house that he wanted, inherited some money from the death of his father, and we were able to get him in a house with verifiable rent, 15% down. He had a union carpenter, he had money in the bank, and so we were able to get him in a situation where he wanted to live. And through Jack's programs, like I said, verifiable rent, good job. He had the reserves after it. It was a win-win for him. And then about a year later, we refinanced him into an FHA loan. So long-term, he's great. And in the short term, your product fulfilled his needs. And he did not think at the time the first time I met with him, Jack, he thought I wasn't going to be able to get it done.
Right.
He says, you're a nice guy, but I don't believe you. That's all.
So, that's the misconception of people out in the marketplace. When the industry fell apart about 12 years ago, all these programs went away.
Yeah, right.
So people would go and they'd look for financing, and everybody kept telling them, no, we can't help you, no, we can't help you, no, we can't help you. So everybody just kind of threw up their hands and said, I give up.
Conditioned to no.
Yeah.
Yeah.
So they've kind of given up. And, the nice thing is these products have been back for about 5 years now. And, it's really now at a point where the consumer is starting to get educated that these programs are available. So obviously, with this borrower, we were able to help him because he had the funds from an inheritance. But what a lot of people don't know is you can actually pull money out of your 401k for a down payment. You don't have to even pull it out. You can actually take a loan against your 401k.
And you're paying the interest back to yourself.
Yeah, exactly. Yes. So instead of paying it to a lender, you're paying it to yourself.
Right.
Because in today's market right now, where the stock market is, it's at an all-time high. So people are worrying, is this going to have a pullback? So if it does have a pullback, you're going to lose some of the value of your money you have invested. So why not, instead pay yourself back and you have a guaranteed return?
On the 401k, if you take a loan against that, and let's say you borrow $10,000, and your monthly payment is $200, $100 a pay period, is that counted in the liability side in the debt ratio calculation?
It is not. So you don't have to count that against somebody.
And that's a niche there, because if you can do that on FHA, but we're going to count that on an FHA loan in the debt ratio calculation.
Correct.
So
another great thing about these loans is you can actually be in a struggling situation now. You can have some mortgage lates recently. You can be late on some of your consumer credit and be just swimming in debt and be, I just need relief. And you may have a house that's worth $250,000 that you owe $120,000, and you have $40,000 in credit card debt, and you have a couple car payments that are really high. You can actually look to consolidate that debt down and get yourself payment relief. And the nice thing is, after that happens, down the road, once you have yourself cleared back up, refinance into a better program, whether it's FHA or conventional.
Something a little bit more long term. And a lot of people they initially say, well, what's the rate on the loan? Even though they're paying off $40,000 in credit card debt, right? And that's instinctively what turns them away from doing it. But collectively, if you're saving $1,000 a month or $600 a month by combining all this, what's the better situation for a client, right?
So, right, and one of our favorite terms is, what's the interest rate? Well, does the interest rate really matter? You don't qualify for any. You can walk into a large bank like a Chase or Wells Fargo or your local credit union. They're all going to tell you, I'm sorry, we can't help you. There's nothing we can do for you. Whereas, like you said, you're saving, right now they may have a payment of $1,200 on their mortgage and $2,000 worth of debt for car payments and student loans and credit cards. You consolidate it down, the payment goes from $1,200 to $1,800 on their mortgage, but they're saving $1,400 a month in payment. Overall. So, that's some major debt relief, for somebody. So, when somebody talks interest rate, you say, all right, well, your interest rate may be going from this to this.
Right.
But what are you paying on your credit cards? Are you paying 19%? Are you paying 21%? Are you paying 27%?
Exactly.
What are you paying?
Right.
What's your overall?
Not tax deductible either.
Exactly.
Right.
Right.
So for those of you recently less than 3 years from a foreclosure, what's the minimum for a bankruptcy, Jack? 1 year out of a bankruptcy, or
For bankruptcy, for a Chapter 13 bankruptcy, which is a repayment plan,
Right.
we actually go off of the file date. It has to be discharged. So
Okay.
they have to have been in it for at least 2 years with paying that Chapter 13 on time.
okay,
For Chapter 7, if you're under a year, that's kind of a case-by-case basis. We will do them. We like to see that somebody included a house in there. So basically, they realized they just couldn't afford the house, so they basically said, I'm going to give the house back. And the easiest way to do that, to be alleviated from that responsibility, is to file a Chapter 7. So if somebody didn't, then we want to see that they're currently paying, the rent payment for at least 12 months. We're going to want to see that they kept some accounts open through the Chapter 7. So like a student loan, you can't discharge that in a Chapter 7. So hopefully you're making those payments. A lot of people will keep their car payments, because it's going to be hard to get a good interest rate if you just filed a Chapter 7.
Right.
So that's kind of, where you're looking at on that.
for the right person, this type of loan makes a lot of sense. You've got money into it, you've got reserves. They're going to thoroughly look at what your payment is now as far as rent and where you're going. That's got to make sense,
Sure,
right?
absolutely.
Payment shock is a big factor here. They don't want to take you out of the fire and put you into the frying pan, so to speak.
Of course, yes.
So if you're an individual who's got money to put down and you're recently out of a bankruptcy or foreclosure, you have options that you may otherwise think that you don't have. And please like and share this to Facebook, and feel free to contact me with any questions. We're happy to take a look at your scenario. Thank you.
Call them today.
Yep. Thanks, Jack.